This video will show how to find the market value based capital structure of a firm, meaning finding the percentage of the capital structure that is debt versus preferred stock versus equity or common stock. At its very basis, it is relatively simple. We need to find the market value of each of these three things in turn, and then we just find out what percentage each is. And the market values come from taking the price of whatever it is and multiplying by the number of those things that are outstanding. So for debt, it's the bond price times the number of bonds outstanding. For preferred, it's preferred price times the number of preferred shares outstanding. And for equity, it's the common stock price times the number of common stocks outstanding. Starting with debt, if you're lucky, you will have a problem that just tells you the market price of a bond, in which case you just put it in here and multiply by the number outstanding. But often you have to piece together the market value of the bond from other information, and that is most easily done with the equals PV formula in Excel. This is shown more carefully in a separate video, which is linked here. So we'll do it relatively quickly here. The bond price equals PV, open parentheses, rate refers to the current market rate, often stated in a problem as the bond is currently priced to yield something. It's given as 8% here. We're going to assume semi-annual payments, so we're going to put in the rate as 4% or 0.04. Next, the number of periods. This has 20 years to maturity, which means 40 payments. Next, the payments are the coupon rate 10% of the face value. $1,000 is $100 a year or $50 semi-annually. And the future value is the face value, $1,000 that we will receive at maturity. We're going to go ahead and throw a negative sign in front of this so the answer comes out positive. The market value of the bond, $1,197.93. And so the market value of all the debt is the value of one bond times the number of bonds that are outstanding. And there it is, 3.6 million roughly. Moving on to the preferred stock. Again, it'd be nice if you were just given the current market value of the preferred stock, but if not, you may need to do a little work by taking the dividend of the preferred stock and dividing by its current market rate, or what it is currently priced to yield, as it may say sometimes. All you do is take the dividend and divide by whatever it is currently priced to yield. $72.73 is the market price of one preferred share. If we take that and multiply by the number of preferred shares outstanding, we get the market value of the preferred stock. Finally, with equity, hopefully you're just going to be given the current market price of the stock. Otherwise, you're going to have to determine it using some other method, such as CAPM or growth dividend model. We're going to assume that we're given the current stock price, $16, and the number of shares outstanding, 300,000. So the market value of the equity is going to be equal to the share price times the number of shares outstanding, 4.8 million. Next, going to move over a little bit here. We're just going to take these values and put them all together. The debt, the preferred, and the equity. We are going to total them, find out our total amount of capital, 8.7 million, and we just now need to find percents. So take the amount of debt divided by the total, the amount of preferred divided by the total, and the amount of equity divided by the total, and you have found the firm's market value based capital structure: 41% debt, 4.2% preferred, and 54.8% equity.